The relationship between macroeconomic health and property values has been a topic of intense discussion and analysis among real estate professionals, economists, and investors. Delving deeper into the intricate interplay between these two spheres, it becomes evident that the broader fiscal landscape is pivotal in shaping the trajectories of property markets. Understanding macroeconomic health. Macroeconomic health refers to the overall well-being and functioning of a country's economy. Key indicators of this health include GDP growth, employment levels, inflation rates, trade balances, and consumer confidence. When these indicators demonstrate positive trends, it signifies a robust and growing economy. The direct influence on property markets. Employment rates. Employment is a primary factor that directly impacts an individual's ability to purchase property. High employment rates mean more people have stable incomes, which increases their borrowing capacity and the ability to service mortgage loans. This heightened demand often results in property prices escalating. Wage growth. When wages grow faster than inflation, the real purchasing power of consumers increases. This can lead to enhanced demand in the property market, especially if buyers believe their future earnings will continue on an upward trajectory. Consumer confidence. This psychological factor can be as influential as tangible ones. When the populace is optimistic about the country's economic future, they are more likely to make significant financial commitments, such as purchasing property. Lending rates and monetary policies. Central banks, in response to macroeconomic conditions, adjust interest rates. Lower interest rates reduce borrowing costs for consumers, making property purchases more attractive and feasible. Conversely, high rates can deter potential buyers. The indirect impact on real estate. Business growth and expansion. Thriving economies often attract businesses, both local and foreign. The resulting expansion can lead to population growth in specific regions, creating demand for housing and commercial spaces. Infrastructure development. Economic prosperity often spurs governments to invest in public infrastructure projects. Improved transportation, utilities, and amenities can make certain regions more appealing, driving up property demand and values. Foreign investment. A robust economy can attract foreign investors looking for stable and lucrative real estate investment opportunities. This influx of capital can significantly boost property values. Conclusion. The symbiotic relationship between macroeconomic health and property markets cannot be overstated. A thriving economy can set the stage for a bullish property market, while downturns can have the opposite effect. For stakeholders like real estate professionals, investors, and policymakers, understanding this relationship is crucial. It helps forecast market movements, develop strategies, and make informed decisions. For visionaries like Pooyan Ghamari, these insights are not just about predicting market swings, but about understanding the deeper socio-economic patterns that influence communities and shape nations. In the intricate ballet of economies and real estate, knowledge of macroeconomic indicators is the choreography that can guide success.